Business Insider said that we had over 422 IPOs open next year. Is there like a rule of thumb when investing in that sector? Do you look to 6 months, or what is your thoughts when investing in a new IPO?
So I've been in a bunch of IPOs. I don't do that in size because I don't think that I'm knowledgeable enough to really be able to tell what's going to work, what's not. It's just not my expertise. But every once in a while, with like a little bit of money on the side, I'll do something like that. So I was in Unity, for example, ticker U. I owned it pre-IPO, part of a fund that owned it pre-IPO, and I'm still in that one. I was in some others that, we flipped out of, but it's not a really big part of my business, to be honest with you. I wish that there were a rule of thumb where you could say, like, this is the right length of time to stay with an IPO, et cetera. But a lot of that depends on the overall market environment. And in some environments, it's different than others. What I found really interesting about the IPOs this year, a lot of people think that all these SPACs that came along, and I know you guys have talked about this before, a lot of people looked at that and said, oh, it's speculative, it's so risky. They had it twisted. It's the opposite. Here's what's going on with the SPAC boom.
Can you talk about the SPAC? Like, what is it? What is that?
All right. So it's a special purpose acquisition corporation. It differs from it goes public like an IPO, but it differs from an IPO in that it's not an operating business. It's basically a famous investor and a bunch of his friends and contacts, or her friends and contacts. They pool their money. They go public to get other people to bring money into the pool. And they say, we have the next 12 to 18 months to use this pile of cash to go buy an operating business. And then we're going to change the name of our SPAC, our Special Purpose Acquisition Corporation, into the name of that business. So that's how DraftKings went public a year ago. So DraftKings was a private company, operated. They sold to one of these publicly traded pools of capital, and that's how they ended up becoming a public company. And the stock has done really, really well because DraftKings is crushing it right now. So that's an example of when it goes right. Okay. The thing with the SPACs, though, that a lot of people don't understand is that hedge funds love SPACs. And why do they love them? Because hedge funds get paid to invest. When they sit in cash, they don't collect their fee on that portion of their portfolio. So, like, picture this. You're a $10 billion hedge fund. You feel like you really don't want to have a lot at stake right now because the market's high, whatever. So you could put that money into SPACs, and it's the equivalent of sitting in cash. And then when that SPAC announces a deal and there's a pop, you could flip out. You could just sell it if you don't like the deal. In the meantime, you were able to bill on those assets. Hedge funds bill 2% management fee just for sitting there. So it was a way for them to not sit in cash and earn billing on assets that were effectively cash. So people are like, oh, yo, it's a speculative mania. Everybody's buying SPACs. No, don't get it fucked up. They're in these things because they're not taking risk.
Yeah,
they're getting paid to not take risk. You have it backwards.
That's
and
a
that
hedge.
Now, when does it get speculative? When the SPAC announces the deal, like one of Chamath's SPACs announced their deal the other day on the air with us, SoFi, right? He had Anthony Noto has a private company called SoFi. So Chamath's group is buying it. It had a big pop. I think it was up 16, 17% on that news. If you stay in it, now is when the risk portion begins, because now it's got an operating company. You're paying a valuation on that, et cetera. That doesn't mean it's good or bad. I'm just saying now it's not cash. Now it's a deal. So I think that nuance gets lost in all of the breathless coverage of like IPOs, SPACs. People don't even understand what's going on. There's always a game behind the game. That's the game behind the game.
That's interesting. For the advisors and the wealth managers, you talked a lot about client alpha being more important than asset allocation. What's like a perfect mix for you as an advisor? And then like when someone like Kathy comes on board and just takes the world by storm as an advisor, do you adjust your strategy? And do you and Barry talk about how to offset the perception of everyone running to ARK, or did you just stay true to the course with the clients you got?
We own all those stocks, but we don't own them in concentrated positions. Like we own the Qs. Okay. I got Tesla. I got all that shit, right? But we're not making concentrated bets. And here is where we dip. By the way, shout to Kathy Wood, active manager of the year. A lot of people don't know she's 65 years old. So this is not an overnight sensation. Like, she worked her whole career and built her contacts and her research ability. She deserves this moment in the spotlight and all her success. I hung out with her on stage at a Bloomberg event. She was like in a leather jacket. I'm just like, you're killing it. She's like, no, not me. No, I'm not killing it. Yes, you are. You want to be in the same stock she's in. The difference is we are working with clients who are, for the most part, already rich. And we have a different responsibility to these families. The responsibility to these families is to keep them rich. So we can have portions of their portfolio in speculative areas of the market, high valuation stocks, cutting edge technology, innovation. I love all that shit. I love it. I just can't have most of their money, because we saw today. I don't know, you guys watch the ticker at all today?
Yep.
Bitcoin had a 20% drawdown today.
Yeah.
Yep.
I called that last week.
Yeah.
Oh, did you?
We've been in that space before where we've seen these large pullbacks.
So we know that this is part of the game.
Yeah.
Now it's a lot of fun on the way up, but there's two things. The first is stocks, and I consider Bitcoin a stock right now. I know it's not, but it is. Stocks take the stairs up and the elevator down. We're clearly seeing a version of that.
Yeah.
And I'm not saying 40,000 is the top, but what if it was, and you had 20% of your assets in that? You know what I'm saying? Like, you forget about percent when you're dealing with wealthy families. So you have a family that's got $5 million and they're counting on that money to fund their lifestyle, fund their children's lifestyle, et cetera. And then that 5 million turned into 4 million in one day. Like, how do you even pick up the phone and have that conversation? So we're trying to take the appropriate level of risk for each family that we deal with, and it's always different. And so that's why when people are like, what's a good rule of thumb? I wish there were a great answer. The reality is the answer is going to be different for every person and every person's situation, which is why generalized financial advice is so difficult.
So let me ask you. I got a couple questions, but first question is, we live in New York. I know you live in New York, so you can, appreciate it. It's
Long Island.
Shout out to Long Island. What do you for your firm? I know you say you work with wealthy people already.
Yeah.
What do you consider to be wealthy?
So I should amend that. We have an automated asset management platform for people with less than $1 million in liquid assets. It's called Liftoff. The URL is liftoffinvest.com. Michael Batnick created all the portfolios on there, and that's a 50 basis point annual fee. It's a phenomenal service. I have accounts set up on there for my kids. So we're not only investing for wealthy people. So Liftoff's got families that we care about. They just haven't gotten to $1 million yet. So that's a very easy online platform. It's built using Betterment's technology and our portfolios. So it's sick. And we love the guys at Betterment, good friends with those guys. So Liftoff Invest is for younger investors, newer investors, people who haven't gotten to $1 million. But our wealth management platform is $1 million liquid and up, which means net of the house, net of any other non-liquid assets. Like, we want to be able to invest at least $1 million for people. And it's not because we think that only they are worthy of that high touch financial plan. It's just that to run a business, you can't say yes to everybody, and you have to draw the line somewhere. For different advisors, that line is drawn in different places. Yeah. I know guys, managing NBA guys' money, and they're not talking to anyone at less than 20 million.
My graduates from my school being Forbes, bag drop.
Bag drop.
A mic drop, bag drop.
Bag drop.